So the 3-box rule is something I use with all my clients. I think it's an invaluable visual aid that I use to map out somebody's future planning so that they can effectively understand how they filter the money that they're earning, hard-earned money I might add, into the right boxes. And this always comes with the vision of what they're trying to achieve and by when. Can I also start, for people new to watching any content that I've put out there, that I'm the type of financial advisor who honestly, hopefully feels a real kind of understanding of how hard you've had to work to earn that money, and certainly with something like COVID-19, that you've got to have a balance in life. Spend some of it, eat it, drink it, go on holiday on it, enjoy it. It's not all about saving, because ultimately, A, life would be very boring, and B, of course, we never know what the future brings. So absolutely a balance is key. But in that, structure is also important. And if this can help, then absolutely follow these principles. When I refer to box one is about you visualizing how much you need in cash. Now, the problems with cash, of course, is the fact that interest rates are now at a historical all-time low. And here's the troublesome thing for anybody looking for interest rates: you're just not going to get them. Historically now we're going to sit probably for another decade of interest rates where you can't beat inflation. So you're going to sit with money sat in a bank account and seeing it effectively erode against the rising cost of living. Now, that's not prudent if that money's not needed in this timescale. So box one is about you isolating now on a blank piece of paper what you need in cash for, of course, emergency funds, that rainy day amount, and certainly more so than ever now with COVID and whether you're fearful of income. But in addition to that, home improvements, next year's holidays, thinking that we can all take a holiday, and so on and so on. So absolutely nailing down how much you need in that area. But it's then challenging yourself to say, once you've isolated all of those elements, what is that additional amount if it's still sat there for? Because if it's sat in an appalling interest rate account, gathering dust and effectively going backwards, why have you left it there? So then we look at box two. And box two now is like anything. It's about trying to get some form of reward. And when we talk about reward in the world I work in, above and beyond the rising cost of living, so above and beyond inflation. Now, to do that, normally we've got to invest in something. And again, in the way I work, that might be using your ISAs, bonds, unit trusts, investing into the market to grow money, stocks and shares for your future. But of course, that in a balanced plan that people follow could be other property, could be artwork, could be watches, could be anything that you perceive is going to appreciate in value. Now, the key thing with box two is you've got to give it time. With all of those things I referred to, investment is about timing. You can't possibly time it perfectly. And anybody who tells you they can, back away from them. So timing means that if you put it into box two, as much as that asset is physically something you can get and take out and again, use again, you've got to allow for some volatility. So whether it's through a channel like myself, through ISAs, etc., or whether it's one of those other asset classes, you've got to be putting it in there to allow that kind of turbulence, and particularly at the time we find ourselves in now. But the positive, and let's be optimistic, is it's equally where opportunity is. Certainly from a market point of view, we will absolutely find the next range of entrepreneurs come out of this period. This country will find a path. The world, global economy will find a way forward. Hard to see right now, I get it, but it absolutely will. And those people I've worked with for a long time, particularly back in 2007, 2008, who trusted that logic, have of course done very well off the back of it. So it's about having the money that can sit in that box, leaving it alone, always typically looking at that 5 year plus time period, but knowing you can get your hands on it. And finally, box number three is absolutely utilising pension. I can't make it sexy, I can't make it exciting, but absolutely is it tax efficient? Yes. Whether you run your own business saving against corporation tax and drawing it as dividends, which you just didn't need or needed to do, or whether as an individual you're saving into a private pension, you shouldn't turn away from it. You know, if you're somebody like me in an age profile in my 40s who can now touch pension at age 57, then why would I back away from that? People's misconception of how you can draw a pension is something you should take advice on. I absolutely maximise mine. It's the biggest bang for my buck. It's how I can save money for my future. And you know what? It's how I can control my future. When I want to retire and what I want that to look like. So it's not all about any one box. It's about having a balance. It's about making sure that balance is right for you as you live today, not something you've been doing 10 years ago and you've just never changed. Take advice. Come and ask somebody like me questions about it, because I'll happily help and blue sky think for you. Get a map, get a plan of action, and take it forward from there. And I think it'd be one of those best things you ever do to have a structure to what you're doing for the future.